Okay, let's unpack this, because General Mills just pulled off what I can only call a mathematical magic trick.
Oh, yeah. It's wild.
Right. Like in the exact same breath, on the exact same earnings call, they reported a quarter where their adjusted earnings per share shot up by an impressive 27%. But simultaneously, they posted a massive, jaw-dropping $2 billion operating loss.
Yeah, $2 billion with a B.
So how is that even possible? How do you synthetically generate a massive per share profit while your balance sheet basically takes a multi-billion-dollar crater?
Well, I mean, it takes some serious accounting gymnastics.
Exactly. So today we're getting into the numbers for General Mills, ticker symbol GIS. For you, the retail investor trying to, allocate capital in the consumer packaged goods sector, this Q4 2026 earnings report is it's a masterclass in why relying on headline algorithms will get you slaughtered.
Oh, absolutely. The headline numbers are totally detached from reality here.
Right, so our mission for this deep dive is to look past the press release. We're going to tear down the financial engineering, the supply chain bottlenecks, and the really aggressive shift in corporate strategy underlying this legacy food giant.
Yeah, and what's fascinating here is that the divergence between GAAP accounting standards and the non-GAAP adjusted metrics that management wants you to focus on, I mean, it's rarely been wider than it is in this specific report.
It's a massive gap.
Huge. When you see a stock post a multi-billion-dollar operating loss, but the stock doesn't immediately enter a free fall.
Which it didn't.
Right, it didn't. And that requires dissecting the mechanics of the income statement. To figure out if this company actually belongs in your dividend portfolio, we have to, isolate the underlying cash generation of their core operations making cereal and pet food from the retroactive punishment of their past capital allocation mistakes.
I love how you put that, retroactive punishment, because that's exactly what it is. And we need to start that isolation process at the very top of the income statement, right? Net sales.
Yep, top line.
So they reported $4.6 billion in the fourth quarter, and the headline reads as a 1% year-over-year increase. But any investor who actually pulls the fiscal calendar knows that 1% is it's a complete illusion.
Totally fabricated by the calendar.
Right, because General Mills operates on a fiscal year that ends on the last Sunday in May.
Yeah.
And because of how the calendar math works out, this particular fourth quarter contained a 53rd operating week.
Right. So they're comping a 14-week quarter against a 13-week quarter from last year.
Exactly. So if you strip out the 7-point artificial volume boost from that extra week, and then you strip out the 1-point tailwind they caught from foreign exchange rates, repatriating weaker overseas currencies, their organic net sales growth is dead flat. 0.
And honestly, achieving even that 0% organic growth required some accounting gymnastics of its own.
Wait, really? Even the 0 was manufactured?
Oh, yeah. When you dig into the supplementary data, physical volume the actual tonnage of product physically moved out of their distribution centers declined.
Wow. Okay, so they shipped fewer physical boxes.
Exactly. The only mechanism that dragged organic sales up to that flat 0 line was a 1-point benefit from favorable trade expense timing.
Okay, break that down for us. Trade expense timing.
Yeah, so we are talking about the accruals for things like market development funds, slotting fees, grocery store end cap promotions, all that stuff.
The money they pay to get premium shelf space.
Right. Because of timing mismatches in when those expenses were officially recognized this quarter versus Q4 of last year, it provided this superficial lift to the net sales figure. So taking a step back, the physical throughput of the business is actively shrinking.
Which makes the bottom line adjusted metric even more wild. I mean, if physical volume is shrinking and organic revenue is flat, a 27% jump in adjusted diluted EPS in constant currency seems mathematically impossible.
It does, unless you engineer it.
Right. Corporate financial engineering steps in. So they utilize 3 specific levers to inflate that EPS.
Let's hear them.
First, a lower effective tax rate. Fine. Second, some actual operational profit expansion, which we'll analyze in a second. But third, and most importantly for the long-term holder, they spent $500 million in fiscal 2026 buying back their own stock.
Right, the share repurchases.
Yeah. When you retire shares, you shrink the denominator. The overall earnings pool doesn't necessarily have to grow for the per share metric to spike.
And the timing of that buyback is it's critical to analyze. I mean, in a high interest rate environment, allocating $500 million to share repurchases instead of aggressively paying down the debt on your balance sheet is a highly opinionated capital allocation choice by management.
Highly opinionated. That's a polite way to say risky.
Right. It signals they believe their stock is trading below intrinsic value.
Yeah.
But it fundamentally relies on the business maintaining a really high free cash flow conversion to justify not paying down that debt.
Which, to be fair, to management's credit, the operational side of the house did actually deliver on margins to support that cash flow.
They did. Their gross margin expanded by 240 basis points to 34.8%.
Right, and a 240 basis point expansion in gross margin, especially in a quarter where aggregate volume actually declined, tells us their price elasticity models are holding up much better than expected.
Yeah, they cited favorable price realization and mix.
Which basically means they didn't just blindly hike prices across the board.
Yeah.
Because if they did that...
Oh, that would have destroyed demand entirely.
Exactly. So instead, they aggressively shifted their sales mix toward premium, higher margin SKUs while successfully passing along targeted price increases. So the core manufacturing and pricing engine is highly efficient right now.
It is.
But that brings us to the elephant in the room, the GAAP operating loss. We have to talk about the $2 billion crater.
Yeah, this is where past hubris meets current accounting standards. The $2.1 billion GAAP operating loss is almost entirely driven by $1.8 billion in non-cash goodwill and brand impairment charges.
Okay, $1.8 billion.
Yeah, plus another $1 billion valuation loss tied to the divestiture of their Brazil business. But let's break down the impairment, because that's the real story. $1.5 billion is specifically assigned to their North America pet reporting unit.
The pet food business.
Right. And another $250 million is tied directly to the Nudges and True Chews pet treat brands.
Okay, let's contextualize this for you, the investor, because goodwill impairments are essentially the ultimate admission of managerial defeat.
Oh, 100%.
Like when General Mills bought Blue Buffalo in 2018 for roughly $8 billion, and then they doubled down, right? They bought Tyson's Cat Treat business in 2021 for another $1.2 billion. They paid massive premiums over the tangible book value of those assets.
Massive premiums.
And that premium is logged on the balance sheet as goodwill. So an impairment charge means the auditors literally ran the discounted cash flow models for these pet brands, looked at the future growth trajectory, and forced management to admit that the future cash flows will absolutely never justify the premium they paid.
Nope, never.
So basically, I have a question. If I total my car on paper, but I still have cash in my wallet to buy groceries, am I rich or poor? Like, how should a retail investor look at this? Because they incinerated billions of dollars of shareholder equity on these acquisitions, but it's non-cash.
Right. It's a great question. Because it is a non-cash charge, meaning it doesn't impact their liquidity today or their ability to fund the dividend this quarter.
Okay, so the dividend is safe.
Yes.
Yes.
But it drastically reduces the return on invested capital for the business over the long run. They bought into the peak pandemic pet adoption boom,
Oh, right. Everyone got a dog in 2020.
Exactly. And management extrapolated those crazy, unsustainable growth rates into perpetuity. Now that pet adoption is normalized, the mean reversion is just punishing their balance sheet. And the operational reality in the pet segment today completely validates the auditor's decision to force this write-down.
Right. So if the pet segment impairment proves they severely misjudged the long-term consumer, I feel like it forces us to scrutinize their entire forward-looking strategy across all the aisles of the grocery store.
Oh, absolutely. It's all connected.
Because to understand why overall volume is shrinking and why that organic sales number is flat, we have to look at the massive strategic pivot management is executing right now.
Yeah, let's talk about the pivot.
So last year, they were totally playing defense. Chief Operating Officer Dana McNabb explicitly stated they relied on, quote, base price investments.
Right, which is corporate speak for cutting prices.
Exactly. They were bleeding market share to aggressive private label pricing on the low end, so they had to compress their own pricing just to stabilize household penetration.
And I mean, that defensive posture worked to halt the bleeding. They stabilized their base volume.
Sure.
But base price investments structurally compress margins. You just cannot operate a legacy CPG company indefinitely by competing on price with store brands. The unit economics simply do not work given General Mills' overhead.
They have too many factories, too much corporate bloat.
Exactly. So, having stopped the volume exodus, CEO Jeffrey Harmening is entirely abandoning the defensive posture. The new operational mandate for fiscal 2027 is a concept they are relentlessly referring to as remarkability.
Ah, remarkability.
Yes.
It's just the new CPG buzzword for aggressive premiumization, right? They realize they can't sell more boxes of cereal, so they have to convince you to pay a massive premium for the exact same physical footprint in your pantry.
That's exactly it.
It relies entirely on functional innovation and new packaging formats. And looking at the Q4 data, we can see exactly where this elasticity thesis is working and where it is spectacularly failing.
Yeah, let's look at the successes first. The wins are deeply tied to specific macronutrient trends. Like management highlighted Cheerios Protein, which just crossed $100 million in sales.
$100 million, wow.
Yeah. They also pointed to Love Made Fresh, which grew by 80% in the quarter.
That's massive growth.
And furthermore, within the pet segment, despite the macro impairment we just talked about, their Tiki Cat brand saw strong double-digit growth.
Okay, so what connects Cheerios Protein and Tiki Cat? It's the functional value add. You take a highly commoditized, stagnant legacy product like standard Cheerios, reformulate it with protein.
Which is basically the only macro trend consumers uniformly agree they want more of right now.
Exactly. Everyone wants protein. And suddenly you immediately command a premium price point per ounce. And the same applies to Tiki Cat. I mean, the humanization of pets means consumers will ruthlessly cut their own discretionary spending before they downgrade their cat's premium wet food.
Exactly. And the margin accretion on these renovated products is massive.
Because it doesn't cost that much more to make.
Right. Because the underlying manufacturing process, the extrusion of the cereal or the canning of the pet food, it doesn't change fundamentally. The gross margin profile expands significantly simply by altering the ingredient mix and wrapping it in aggressive remarkability marketing.
It's brilliant when it works.
Yeah.
But premiumization is a high-wire act, right? And when the value proposition misaligns with consumer expectations, the volume destruction is just instantaneous.
No, it falls off a cliff.
Which brings us to the Totino's disaster.
Yeah, ouch.
Totino's pizza rolls were a massive drag on the North America retail segment this quarter. COO Dana McNabb basically admitted on the call that they executed a, quote, price pack architecture conversion that was not great.
Understatement of the year.
Right. So let's deconstruct price pack architecture for a moment. PPA. Because this isn't just changing the color of the box, this is the highly calculated behavioral economics of the freezer aisle.
Price pack architecture is an exact science. It's the balancing of unit volume, package sizing, and psychological price thresholds. A consumer has a hardwired expectation of what a snack should cost to feed their family on a Friday night. When management bungles a PPA conversion, it usually means they push the shrinkflation lever too hard.
Like giving you fewer pizza rolls for the same price.
Right. Perhaps reducing the count from 50 rolls to 40 while holding the price at 4.99. Or alternatively, they breached a psychological barrier, maybe pushing the price from $4.99 to $5.49.
And in a category like frozen snacks, the switching costs are effectively zero. If you breach that psychological threshold, the consumer simply reaches 6 inches to the left and grabs the store brand Pizza Bites.
Yep. They just pivot.
The immediate volume loss Totino's suffered proves that while consumers will pay up for functional benefits like protein, they absolutely will not tolerate margin padding on basic legacy snacks.
And that precise dynamic, the fragility of consumer elasticity, it brings us back to the core operational problem in the pet segment.
Oh, right, the inventory issue.
Yeah, because beyond the impairment charge, the actual physical throughput of the pet business is flashing warning signs. North America pet organic sales declined 3% in the quarter.
Right, but wait. Management noted that retail sales, like the point of sale data representing what consumers actually scanned at the register, were up 1%.
Exactly. You have a 4-point divergence between factory shipments and retail takeaway.
That is wild. So people are buying it at the store, but General Mills isn't selling it to the store.
Right. And that 4-point gap is not a temporary glitch. It represents a permanent structural realignment in working capital across the retail ecosystem.
How so?
Well, historically, pet food was a game of massive backroom inventory. Traditional big box pet retailers and massive grocery chains carried weeks of supply on hand to ensure they never ran out of bulky 40-pound bags of kibble.
Right, because it takes up so much space, you just stack it in the back.
Exactly. But the fastest growing channels for the pet category today are e-commerce and mass retailers like Target or Walmart. These channels do not operate with deep backrooms. They run highly optimized, algorithmic, just-in-time inventory systems. They have permanently reduced their days inventory outstanding.
So they're pushing the risk back onto General Mills.
Completely. They're forcing the manufacturer to hold the inventory risk, only ordering precisely what their predictive models suggest will sell in the next 48 to 72 hours.
Wow. And management explicitly acknowledged this, right? They stated they expect a continuing low single-digit headwind from retail inventory in FY 2027.
Yeah, they know it's not going away.
So as more consumer volume shifts from legacy pet stores to e-commerce, the aggregate physical storage capacity of the retail channel permanently shrinks. General Mills can never again stuff the channel with excess inventory to make a quarter look good because the digital channel physically cannot hold it.
Exactly. This structural reduction in expected shipment volume is the operational reality that broke their discounted cash flow models and triggered that $1.5 billion impairment.
Okay, here's where it gets really interesting to me. When you synthesize the Totino's elasticity failure, the pet channel inventory contraction, and this intense reliance on premiumization via remarkability, you expose a massive glaring contradiction at the heart of their corporate strategy.
Oh, a huge contradiction.
Throughout the earnings call, management repeatedly emphasized that the consumer is, quote, pressured, value-seeking, and relying heavily on promotions.
Right.
So if consumers are strapped for cash, why is General Mills' big bet to sell them premium, high-protein cereal and bold flavor snacks? If your macroeconomic data is screaming that the consumer is financially exhausted, how can you possibly justify a corporate strategy entirely reliant on selling them premium, high-margin functional foods?
Well, that's the million-dollar question.
If the grocery budget is squeezed, consumers aren't trading up to Tiki Cat and Cheerios protein. They're trading down to private label oats and bulk kibble.
Right, but the only way their strategy functions is if they are completely writing off the aggregate macroeconomic data and focusing exclusively on the K-shaped recovery model.
Okay, explain the K-shaped recovery for this context.
So the economy has aggressively bifurcated. The downward arm of the K, the low to middle income consumer, has depleted their excess savings and is facing structural affordability limits.
They are tapped out.
Completely. They are already lost to private label. But General Mills' remarkability strategy is an explicit bet on the upward arm of the K.
The high-income consumer.
Right. The high-income consumer is still experiencing wage growth, their asset values are high, and while they may be trading down from, say, expensive restaurant dining to eating at home, they are aggressively trading up within the grocery store to replicate those premium experiences.
Oh, wow. So General Mills is essentially conceding the volume war on the low end just to protect their margins on the high end.
Exactly.
Man, conceding the volume war is a terrifying prospect for a legacy manufacturer, and it directly explains the brutal reality of their fiscal 2027 guidance. This is where the rubber meets the road for you, the retail investor.
Yeah, the guidance is rough.
The guidance for the next 12 months is basically a corporate crash diet. They project organic net sales to be between down 1.5% and up 0.5%. Adjusted operating profit is guided down 8 to 13% in constant currency, and adjusted EPS is targeted at $3 to $3.20.
I mean, if we connect this to the bigger picture, a legacy CPG company guiding for an 8 to 13% decline in operating profit is a massive red flag regarding their internal cost structure.
It really is.
The math of negative operating leverage is punishing them. When your top-line revenue is flat or slightly negative, but your fixed overhead costs, your factories, your logistics, corporate payroll remain static, your profit margins compress exponentially.
Right, the factories still cost the same to run even if they're making fewer boxes.
Exactly. And exacerbating that negative leverage is the persistent specter of inflation.
Let's talk about inflation, because CFO Kofi Bruce outlined an assumption of 4 to 5% net inflation for fiscal 2027. And he explicitly noted this model assumes crude oil stabilizes around $100 a barrel.
Right.
Now, for anyone wondering, it is crucial to understand why a company making flour and pet treats is so deeply tethered to crude oil futures.
It touches everything.
It does. Oil is the primary input cost for the plastic resins in their packaging, the diesel fueling the logistics network that moves their heavy products around, and the fertilizer required by the agricultural sector that supplies their grains.
And to mitigate this volatility, General Mills utilizes massive hedging programs on the Chicago Mercantile Exchange, locking in forward contracts for wheat, corn, and energy. Management confirmed they are currently hedged out roughly 8 to 9 months. However, hedging is not a magical shield. It simply delays the inevitable recognition of spot market prices.
Right. As those older, cheaper forward contracts roll off in the first quarter of 2027, General Mills is going to be forced to execute new contracts at current elevated spot prices.
Yeah, the pain is coming.
And CFO Bruce was highly transparent about the specific mechanism, warning that the negative impact of inflation will drastically outweigh any internal cost savings in Q1. The guidance assumes a brutal first half of the year, with any hope of operating profit recovery heavily back-weighted to the second half of 2027, as they basically just pray their productivity initiatives catch up to the inflation curve.
Yeah, and this realization that category volume growth is dead and inflation is permanently higher has forced management into an aggressive defensive restructuring.
The diet.
They announced a staggering $3 billion cost savings target through fiscal 2030, with $750 million slated to be cut in 2027 alone. If you cannot grow the top line and you refuse to cut the dividend, you must hollow out the middle of the income statement.
So it's like trimming the fat off your household grocery budget just so you can afford to buy one nice steak on the weekend.
Pretty much.
But I have to ask you, are these cost savings actually going to reach the bottom line, or are they just going to be eaten alive by the 4 to 5% inflation?
Well, they're hoping it offsets it, but it's going to be tight. This $3 billion extraction is divided into two distinct initiatives.
Okay.
$2 billion is tasked to holistic margin management, or HMM. The remaining $1 billion is tied to a new global transformation initiative. Let's dig into HM first, because this is where the actual engineering of the food changes.
Tell me about HMM.
HMM is essentially value engineering, stripping out costs from the product or the supply chain that the consumer theoretically doesn't notice.
Notice you said theoretically.
Right. Because in practice, HMM means aggressive SKU rationalization, optimizing pallet configurations to fit more boxes on a single diesel truck, and reformulating recipes to utilize cheaper, interchangeable commodity ingredients without altering the core flavor profile.
Wow, okay.
It is the blocking and tackling of CPG margin defense. However, HMM has physical limits. You can only thin out the cardboard on a cereal box so much before it crushes in transit.
Right. You can only hollow out the box so far, which is why they need the additional $1 billion global transformation initiative.
Exactly.
Because COO Dana McNabb gave a very revealing quote regarding their supply chain. She called it the best in food, but admitted it was, quote, built for a different time.
Yeah, that's a polite way of saying it's obsolete.
Right. Legacy CPG supply chains were designed for massive, uninterrupted, uniform production runs. You turn the machine on, and it makes millions of identical boxes of standard Cheerios for a month straight.
But the modern consumer, driven by the fragmentation of tastes and the demand for this remarkability, requires extreme flexibility. They want smaller, specialized runs of high-protein variants, limited-time bold flavors, and highly segmented price pack architectures.
Yeah. You can't just make one thing anymore.
No, you can't. And retrofitting massive, inflexible legacy manufacturing plants to handle nimble, short-run packaging shifts requires immense capital expenditure and sophisticated ERP software upgrades. That global transformation initiative is the expensive process of digitizing and retooling their physical footprint to actually execute the premiumization strategy.
Okay, so let's summarize where we are. We have flat to negative sales guidance.
Yeah.
We have negative operating leverage driving profit down double digits, a Q1 margin cliff due to expiring commodity hedges, and a massively disruptive internal restructuring required just to keep pace with the fragmented consumer.
It's a tough setup.
Which leads us directly to the bottom line. How do we synthesize these conflicting data points into an actionable thesis for the retail investor?
Well, before issuing a verdict, we must address the ultimate bailout strategy that investors often speculate about when a CPG giant's organic growth stalls.
Mergers and acquisitions.
Right. Will General Mills simply leverage their balance sheet to buy a fast-growing, trendy brand to artificially inject top-line growth into the narrative?
Yeah, that's the classic move. But CEO Jeffrey Harmening effectively killed that thesis on the call.
He did.
While maintaining the standard corporate line that they are always on for M&A, he explicitly stated the bar for acquisitions right now is, quote, very, very high.
Right.
They are prioritizing organic growth and, crucially, balance sheet leverage reduction. Given the current cost of debt capital and the fresh scars of the $1.5 billion pet impairment, management knows that attempting to buy their way out of this growth stall would likely trigger a revolt among institutional shareholders.
Oh, the market would punish them severely. That discipline is commendable, honestly. But it forces the stock to trade purely on the merits of its operational execution over the next 12 months.
Right. So where do we stand?
Weighing the impressive 240 basis point expansion in gross margin against the reality of a guided 8 to 13% decline in operating profit, our stance on General Mills going into fiscal 2027 is a cautious, bearish to hold signal.
Yeah, I have to agree. The fundamental issue is that management is asking you, the investor, to endure a lost year. You are being asked to stomach severe margin compression in the first half of the year while blindly trusting that their internal $3 billion cost-cutting diet will eventually outpace sticky inflation.
Exactly. Furthermore, the entire remarkability thesis hinges on the assumption that the high-end consumer will remain resilient and willing to pay premium prices, even as macroeconomic indicators suggest widespread consumer exhaustion.
It is an execution tightrope with zero margin for error. If the upward arm of the K-shaped economy finally cracks and high-income consumers pull back on premium pet food and functional snacks, General Mills has no defensive fallback position, having already ceded the value shopper to private label.
Yep, they burn the boats.
Couple that vulnerability with the permanent, ongoing inventory headwinds in the e-commerce pet channel, and the catalyst for multiple expansion is virtually non-existent in the near term.
So what does this all mean? It means patience is required. They are cleaning up their balance sheet and their box sizes, but the growth engine is currently in the shop.
For the retail investor managing their own portfolio, the action plan is clear. If you currently hold GIS, you are essentially holding it as a barn proxy. You are collecting the dividend and trusting that the $750 million in targeted 2027 cost savings will protect the absolute floor of the stock price while they undergo this multi-year supply chain transformation.
Right. You're getting paid to wait.
But if you are sitting on fresh capital looking to initiate a position in the consumer defensive sector, the heavy back half weighting of their profitability guidance dictates that there is absolutely zero rush to buy General Mills today.
No rush at all.
The mathematics of their expiring hedge book guarantee a rough first quarter. The optimal strategy is to deploy that capital into equities with actual top-line momentum or simply collect a risk-free yield while forcing General Mills to prove over the next 2 quarters that their premiumization strategy can actually generate volume.
The risk-to-reward asymmetry simply isn't present for new money until they demonstrate that the structural changes to their price pack architecture are actually resonating with the consumer at the register, rather than just optimizing their internal spreadsheets.
Well said. As we conclude this deep dive into the underlying mechanics of General Mills' transition, there's one final, larger macroeconomic thread that this earnings call exposes.
Yeah, this is the really fascinating part.
A dynamic that goes far beyond the ticker symbol GIS and strikes at the heart of the American grocery landscape.
This raises an important question. The broader issue revolves around the strategic vacuum being created by these legacy food giants. Management was incredibly candid that lower-income households are retreating entirely to basic staples to survive the cumulative weight of inflation.
Right. They know people are hurting.
Yet, in response, General Mills is consciously directing nearly the entirety of its innovation pipeline, its marketing spend, and its capital expenditure toward the premium tier to capture the affluent shopper.
By pivoting so aggressively toward remarkability and functional premiumization to protect their gross margins, are companies like General Mills quietly, permanently abandoning the budget-conscious middle class.
It certainly looks that way.
And if they willingly cede the massive volume of the value shopper to private label store brands like Walmart's Great Value or Costco's Kirkland, they are breaking multi-generational brand loyalty.
Right, because once a family realizes the store brand pizza rolls are just as good and cost 30% less, they never go back to the legacy brand.
Never. How General Mills navigates this strategic abandonment over the next 12 months won't just determine their fiscal 2027 operating profit. It will likely dictate their structural relevance in the American pantry for the next decade.
It's a huge gamble.
It really is. Thank you for joining this Talk Tickers deep dive. Keep questioning the headline numbers, demand to understand the mechanics beneath the adjusted metrics, and always allocate your capital with context.